What if the biggest financial threat right now isn't a stock market crash, isn't a recession, and isn't even runaway inflation? What if the real danger is far quieter? What if the real risk is that nothing visibly breaks at all? Because right now, the US Federal Reserve is dealing with a problem it has never truly solved before. Not a temporary crisis, not a policy mistake, not a single bad decision, but a structural trap created by decades of debt, changing demographics, and unavoidable math. Debt levels are historically high, interest rates are no longer cheap, and keeping the system stable may require slowly reducing the value of money over time. So when people say the Fed just broke, what are they actually saying? And is it really possible that your dollars could be worth far less by 2026, even if there's no collapse, no panic, and no dramatic headline? Let's walk through this carefully based on facts, history, and incentives, not fear. Let's start with what "the Fed is broken" really means. The Federal Reserve is not broken in a technical sense. Banks still function, markets still open, payments still clear. The dollar still works. Nothing is malfunctioning. What's broken is flexibility. For most of modern history, the Fed had room to maneuver. If inflation rose, it could raise rates aggressively. If the economy slowed, it could cut rates and stimulate growth. Today, that freedom is gone. Why? Because the Fed is now trying to balance three goals that increasingly conflict with each other. First, control inflation. Second, keep US government debt affordable. Third, prevent financial system stress. In the past, inflation control came first. Today, debt has changed the equation. US federal debt has exceeded $34 trillion. And that debt is not fixed forever. It must be refinanced constantly. Here's a simple but uncomfortable fact. Every 1% increase in interest rates adds hundreds of billions of dollars per year in interest expense for the federal government. That means interest on the debt is becoming one of the largest items in the federal budget. So here's the question that matters. If inflation starts rising again, can the Fed realistically keep rates high for many years? Or does the math eventually force it to choose a different path? That's why people say the Fed is broken. Not because it can't act, but because every action now carries severe consequences. Now let's talk about the debt reality most people overlook. Ask yourself this: why does inflation suddenly become unacceptable only after debt reaches extreme levels? In earlier decades, the US handled high interest rates. They were painful but manageable. Today, they're structurally dangerous. Why? Because a large portion of US debt matures every few years. Between 2025 and 2027, trillions of dollars in Treasury securities come due. That debt must be refinanced at prevailing market rates, not old rates, not emergency rates, current rates. So what happens if rates stay high? Deficits widen, interest costs surge, political pressure increases. Financial conditions tighten across the economy. That's when markets begin to feel stress, not because of panic, but because of arithmetic. This is why many analysts argue the Fed is no longer truly independent. Not because politicians control it, but because debt dynamics do. The Fed may want to fight inflation aggressively, but the system may not allow it to do so for very long. Now here's a critical question. When inflation started falling from its peak, did your cost of living actually go back down? Did rent drop meaningfully? Did groceries return to old prices? Did insurance or healthcare get cheaper? Of course not. Prices didn't fall. They just stopped rising as fast. This is where most people misunderstand inflation. Inflation does not need to be high to hurt you. It only needs to stay higher than income growth. Even 2 to 3% inflation, compounded year after year, steadily erodes purchasing power. Now layer on reality. Wages don't rise evenly. Many essential costs, housing, healthcare, education, insurance, rise faster than official inflation. Cash has no built-in protection. So even when inflation looks under control in the data, your real purchasing power may still be shrinking, quietly. Now let's address the most provocative word in the title: worthless. Does that mean the dollar disappears? Does it mean hyperinflation? Does it mean collapse? No, that would be misleading. What worthless really means in this context is much more subtle. It means your dollar buys noticeably less over time, fast enough to matter, but slow enough to avoid panic. This is not hypothetical. It has happened before. In the 1970s, the United States did not collapse. The government did not default. The dollar did not disappear. But over that decade, the dollar lost more than 60% of its purchasing power. Life continued. People worked. Markets functioned. But savers lost ground. And that's the key lesson. A currency does not need to fail savers. It only needs to lose value faster than people expect. So why does 2026 keep coming up? Why not 2035 or 2050? Because several pressures converge in the mid-2020s. First, the refinancing wall. A large share of U.S. government debt matures between 2025 and 2027. Refinancing that debt at today's interest rates dramatically increases federal deficits. That creates pressure for rate cuts, even if inflation hasn't fully returned to target. Second, structural spending growth. Social Security grows automatically. Medicare grows automatically. Interest expense grows automatically. These are not political decisions. They are built into the system. That means deficits persist even when the economy is doing relatively well. Third, global demand dynamics. Foreign governments and institutions still buy U.S. treasuries, but demand growth has slowed. Not abandonment, diversification. That reduces the margin for error and increases reliance on domestic buyers and central bank balance sheets. None of this means collapse, but it does mean constraint. Here's the real risk most people miss. The dollar doesn't need to crash for you to lose. All it needs is moderate inflation, flat real wages, rising essential costs, limited policy flexibility. That combination quietly transfers wealth from savers to borrowers, from cash holders to asset owners, from the uninformed to the prepared. No sirens, no emergency broadcasts, no dramatic headlines, just a gradual squeeze. So, is the dollar actually doomed? No. The US dollar remains the world's reserve currency. It is the primary settlement currency for global trade. It sits at the center of global finance. There is no realistic short-term replacement. But reserve currency status does not mean invulnerability. It means any decline happens slowly, quietly, and in a managed way, which can be more dangerous for people who aren't paying attention. Now let's talk about what sophisticated investors are actually doing. Despite online panic, smart money is not betting on collapse. They are not expecting hyperinflation. They are not assuming the dollar disappears. Instead, they are asking a different question. How do you preserve purchasing power in a system designed to reduce real debt burdens? That leads to diversification beyond cash, assets with pricing power, exposure to productive systems, avoidance of long-term fixed returns that don't adjust for inflation. This is not fear, it's adaptation. So here's the most important question. If the Fed can't keep rates high forever and won't allow a deflationary collapse, what outcome remains? A slow erosion of purchasing power. Not dramatic, not catastrophic, but very real. The dollar will not vanish by 2026, but many people may realize too late that their money buys far less than it used to, even though everything still looks normal. That's how highly indebted systems adjust, quietly. And the people most affected are the ones who assumed stability meant safety. If you're listening to this and thinking, nothing here sounds extreme, that's the point. The biggest financial shifts rarely announce themselves. They happen gradually, then all at once in hindsight. And the difference between being prepared and being surprised is understanding the incentives before they become obvious. That's the real story behind the idea that the Fed just broke. Not collapse, not chaos, but constraint. And what that means for your money depends entirely on whether you see it coming. If this breakdown helped you see what's really happening beneath the headlines, don't stop here. The system rarely rewards people who react late. It rewards those who think early. Subscribe to stay ahead of the shifts most people won't notice until it's too late. Like this video so others can find it without the noise and clickbait. And leave a comment with the one question you still have about the Fed, inflation, or the dollar, because that question may shape the next episode. Awareness is the real advantage. This is what Money Hub is about. Not panic, not predictions designed to scare you, but understanding how money systems actually work before they quietly work against you. Because by the time everyone agrees something has changed, the opportunity to prepare is already gone. Money Hub exists for people who don't want noise, who don't want clickbait, who want clarity, context, and long-term thinking in a short-term world. If you're here, it's because you're not trying to get rich fast. You're trying to avoid getting poor slowly. So subscribe to Money Hub if you want to understand the forces shaping your money before they show up in your bank account. Like the video if this helped you see the system more clearly. And comment below with the one thing you're doing differently after watching this, because awareness only matters if it changes behavior. At Money Hub, we don't chase headlines, we decode them. See you in the next breakdown.